The other company we picked this in our part 3 is CNOOC. CNOOC is the largest producer of offshore crude oil and natural gas in China and one of the largest independent oil and gas exploration and production companies in the world. The company mainly engages in exploration, development, production, and sale of crude oil and natural gas. This is the financial results of the company in the first quarter of 2024. So total revenues increased by 14.1%. Profit attributable to shareholders of the company increased even more by 23.7% to 39.7 billion yuan in the first quarter this year. Basic earnings per share increased also by the same by the same rate, 23.7% to 84 cents, 84 fund in the first quarter. Weighted average return on net assets was 5.79% in the first quarter. Saw an increase by 0.54 percentage points. And the total of final dividend and interim dividend for 2023 are 1.25 Hong Kong dollar per share. Dividend yield is about 6.2% at current share price. Okay, in the first quarter, oil and gas sales realized price. The revenue from crude and liquid. So it has two business segments. One is crude and liquids exploration and sales of crude and liquids. The other is exploration and sales of natural gas. So in the first quarter, revenue from crude and liquid sales amounted to 78.2 billion, up 23.6% year-on-year. Also helped by, besides increase in output, crude and liquid output, it's also helped by the rise in average realized price in the first quarter. The average realized price of its crude and liquids in the first quarter was $78.75 per barrel, up 6.2%. However, natural gas was down 7.7% in the first quarter because in the first quarter, global natural gas also saw a decline. It was affected by the drop in natural gas price globally. But increase in natural gas output help its revenue grow despite the drop in realized price. Revenue from natural gas increased by 7.9% in the first quarter year-on-year to 11.774 billion yuan. Okay. All-in cost was well controlled and reduced by 2.2%. Why net profit increased more than the growth in revenue is partly due to the drop, the reduction in all-in cost, which was reduced by 2.2% in the first quarter. So this is a comparison. In first quarter of 2023, all-in cost was 28.22, and in first quarter this year, all-in cost was 27.59 US dollar per BOE. BOE stands for barrel of oil equivalent. That means to produce 1 barrel of oil equivalent. Last year in the first quarter, the cost was 28.22 US dollar. This year, first quarter, it was reduced to 27.59. So the lower the cost, the better the margin. Okay. Another plus was the strong production growth continue. In the first quarter, the company's net oil and gas production was 180 million barrels of oil equivalent, BOE, an increase of 9.9% year-on-year. It is due to, because CNOOC has onshore and offshore overseas production. Okay, so growth in China. This part is the revenue. The oil and gas production from China. Growth in China mainly attributable to increased production from newly on-stream oil and gas fields, while overseas growth was mainly driven by production ramp-up in Guyana and Canada. Its overseas oil fields are quite diversified. It has oil fields in Asia, ex-China, also in Oceania, Guyana, Africa, North America, excluding Canada, and Europe as well. South America, it also has oil fields in South America. Okay. In the first quarter, it has 1 new discovery and 4 successful appraisals of oil and gas structures. This one is within China. This one is overseas, Bluefin. And its key project, 瑞中 36-1 Luda 52 oil field secondary adjustment and development project has been put into production, and other new projects are progressing smoothly. So we are quite confident that it will see continuous growth in oil and gas production. Okay, oil price remain, although fluctuating between $70 and $90, it remains stable. And recently, because of geopolitical tensions, oil price holds above $80, which is in favor of CNOOC. Okay. What are the recommendation reasons behind CNOOC? First of all, the EIA forecasted global liquid fuels consumption averages 102.9 million barrels per day in 2024 and 104.3 million barrels per day in 2025, especially non-OECD Asian countries, particularly China and India, will drive global liquid fuels demand growth. And the ongoing recovery and positive trajectory of China's economy supports the demand for oil and gas. The offshore oil and gas serves as a significant growth driver for oil and gas production in China. So compared to PetroChina, CNOOC has more overseas oil fields. So the offshore and also overseas oil and gas production and exploration will be a significant growth driver for CNOOC. OPEC Plus production cut to persist. In the recent meeting, OPEC Plus announced they will extend the production cut to 2025. This is poised to support oil price, and the IEA expects a shift from surplus to slight deficit for the global oil market in 2024. We expect sustained output cuts and from OPEC Plus, and geopolitical tensions will also lend support to oil prices, which could fully benefit CNOOC. Okay, so the share price also outperformed the market. You can see since January, the share price rose from around $12 to current share price is 21, around 21 Hong Kong dollars. Yet it is still trading below its peers. This red line represents the peers' average daily multiple in terms of price to book value. Sorry, the red line is CNOOC, whereas the white line, the red line is the peers, and the white line is CNOOC. It underperformed, lags behind that of its peers for the more since 2020, and entering 2024, it has caught up. You can see now the P/book has risen to 1.26 times. Okay, so if its share price now is a bit pricey. We will recommend to enter between $19.50 Hong Kong dollar and 20 Hong Kong dollar. If there's a correction to 1950, between 1950 and 20, it would be a good entry level with the dividend yield around close to 7%. Okay. Its ROA, ROE, and net profit margin and earning per share are much higher than the other two Chinese oil and gas companies, namely PetroChina and Sinopec. Okay, in terms of people, it's more expensive, more pricey. Now it's trading at 1.3 times people, whereas PetroChina is trading at 0.82 times, and Sinopec is even cheaper at 0.63 times people. But because Sinopec is trading is cheaper in terms of people, its dividend yield is higher. Yet, in terms of ROA and ROE, there's a reason for its higher valuation. Its ROA is 12.3%, much higher than that of PetroChina and Sinopec. And ROE at 18.58% is also much higher than that of PetroChina and Sinopec. Net profit margin also much higher compared to PetroChina and Sinopec, and earning per share as well. So that's the reason why its valuation, the other two are still trading below their book value, while CNOOC is trading above the book value. We still will recommend CNOOC because of higher ROA and ROE, and is not really attracted to the lower valuation, particularly Sinopec.